The system didn't collapse overnight. It rotted, quietly, invisibly. While screens stayed green and headlines whispered reassurance, the foundation of money itself began to crack, not with explosions, but with distortion. Look closer. Currencies are melting in slow motion. What once bought stability now buys excuses. Governments print not because they want to, but because they have no choice left. Debt compounds faster than growth. Trust evaporates faster than savings. And in the middle of this decay, one signal is screaming, ignored by most, feared by a few: the gold-silver ratio. For centuries, gold and silver moved like twin stars, never equal, but always bound by gravity. When empires were honest, the ratio stayed tight. When systems lied, it stretched. When collapse approached, it snapped. Today, it's stretched beyond recognition. Gold stands tall, crowned as the ultimate safe haven. Central banks hoard it. Headlines celebrate it. It glows under the spotlight like a sanctioned truth. But silver, its monetary twin, has been pushed into the shadows. Undervalued, suppressed, treated as an industrial sidekick instead of what it has always been: money. And this imbalance is not natural. This is what distortion looks like. The ratio is no longer signaling confidence, it's signaling stress. A system pulling one asset upward while crushing the other beneath layers of paper contracts and synthetic supply. Silver isn't cheap because it's weak. It's cheap because it's controlled. Every manipulated system leaves fingerprints, and this one leaves numbers. When fear rises, gold moves first. But when panic arrives, silver doesn't follow, it detonates. Historically, silver waits. It's patient. It absorbs pressure while the ratio climbs to absurd levels. Then, without warning, gravity takes over. The ratio collapses, not because gold falls, but because silver explodes upward to close the gap. This is the moment before that snap. The public doesn't feel it yet. They're told inflation is cooling, that debt is manageable, that this time is different. But the ratio doesn't lie. It never has. It measures stress between real assets when trust in paper begins to fail. And right now the stress is extreme. Silver is priced as if demand were optional, as if technology could function without it, as if solar panels, electric vehicles, medical devices, and global electrification could simply substitute it away, as if above-ground inventories weren't vanishing, as if years of underinvestment hadn't hollowed out supply. This isn't ignorance, it's denial by design, because silver exposes something gold alone cannot: scale. Silver is small enough to move violently, but essential enough to matter globally. When it reprices, it doesn't whisper, it shouts. And those shouts reveal who was positioned and who was trapped. That's why it's dangerous. Danger to banks that sold silver they never had. Dangerous to markets built on leverage. Dangerous to narratives that claim inflation is temporary while real assets scream otherwise. So the system does what it always does before a break. It delays. It distracts. It elevates gold as the responsible hedge, while quietly smothering silver beneath futures, ETFs, and paper promises. It hopes the public won't notice the imbalance, won't ask why one monetary metal is revered while the other is ridiculed. But cycles don't care about ridicule. They only care about pressure, and pressure is building. The gold-silver ratio isn't just a number. It's a warning light. It tells us when faith in money is cracking unevenly, when one asset is allowed to reflect reality and the other is forced to pretend nothing is wrong. Right now, the pretending is reaching its limit, because no system can suppress a monetary metal forever. Not when supply tightens, not when industrial demand accelerates, not when trust in paper erodes simultaneously. This is not the explosion yet. This is the silence before it. The moment where imbalance feels normal because it has lasted too long. The moment where silver looks boring, irrelevant, forgotten. That's always when it's closest. And when this ratio finally breaks, it won't be gradual. It won't be polite. It will be violent, historic, and irreversible. Not because silver changes, but because the system around it fails to hold. The pattern never announces itself. It repeats quietly, patiently, across centuries, waiting for pressure to build again. Every monetary system leaves behind a signature, not in speeches, not in laws, but in ratios, relationships, distortions that only appear when trust begins to fracture. And among all of them, none is more revealing than the relationship between gold and silver. Because long before charts existed, before central banks, before derivatives and leverage, civilizations understood something simple. Gold and silver were money, together. Different weights, different roles, same truth. When Rome was strong, the ratio was stable. When Rome debased its coinage, the ratio drifted. When the empire lost control, silver vanished, and collapse followed soon after. The same story replayed through medieval Europe, through the Spanish Empire, through every system that believed it could bend monetary reality without consequence. The ratio always widened before the fall, not after. This is the part modern investors misunderstand. They think silver moves because of gold, but history shows the opposite. Silver moves because of stress, because when systems strain, the smaller monetary metal absorbs the imbalance, until it can't. Look at the 19th century. Nations struggled to maintain bimetallic standards as industrialization accelerated. Silver was demonetized, pushed aside, declared lesser. The ratio exploded, and with it came banking crises, currency resets, and social upheaval. Silver didn't fail the system failed silver. Fast forward to the 1930s. Debt strangled economies, confidence evaporated. Gold was locked away, confiscated, revalued. Silver, meanwhile, was first ignored, then suddenly repriced. The ratio collapsed not because gold fell, but because silver surged as monetary pressure searched for release. Then the 1970s, the final break from gold. Fiat money unleashed. Inflation devoured purchasing power. Again, the ratio climbed, slowly, deceptively, until silver erupted. In just a few years, silver multiplied many times over, dramatically outperforming gold. Not speculation, not mania, reversion. This is the pattern they don't teach. Gold signals fear, silver signals failure. Gold moves when people worry, silver moves when systems crack. That's why silver's explosions are violent, short, and unforgettable. They don't last long, but they rewrite wealth permanently for those positioned early. And each time the setup looks the same. First, silver is declared obsolete, too volatile, too industrial, too inconvenient to be real money. Then paper claims multiply, futures, promises, synthetic supply that dwarfs physical reality. The ratio climbs higher than logic allows, higher than history justifies. Then something breaks. The pattern is not random, it's structural. Gold is hoarded, silver is consumed. Gold sits in vaults, silver disappears into technology, medicine, infrastructure. Every year, more silver is used than recovered. Every year, inventories shrink while paper claims expand. This asymmetry is the fuel. Throughout history, the ratio has always sought balance, not perfection, but sanity. When it strays too far, it doesn't gently correct. It overshoots in the opposite direction. Because markets driven by leverage and denial don't unwind calmly. They snap. And that snap is always blamed on something else. A war, a crisis, a policy mistake, a black swan. But the ratio tells us the truth earlier. It tells us the system has already been lying for years. Right now, the ratio sits at levels only seen during the most extreme moments of monetary stress. Moments that were never stable. Moments that never resolved peacefully. Moments that ended with silver dramatically reasserting itself, not as an industrial input, but as money rediscovered in panic. This is not a prediction, it's a recurrence. The same imbalance, the same excuses, The same belief that this time is different, that technology has changed the rules, that central banks are smarter now, that suppression can last forever. Every empire believed that. None of them were right. The pattern doesn't care about intent. It doesn't care about policy. It doesn't care about narratives. It only responds to pressure. And pressure always seeks the weakest point. Silver is that point. Not because it's fragile, but because it's small, essential, and impossible to fake forever. The pattern is clear. The ratio stretches. Trust erodes. Paper multiplies. Physical tightens. And then suddenly, violently, the math reasserts itself. Those who understand the pattern don't wait for permission. They wait for inevitability. History doesn't repeat itself perfectly. It echoes. The details change. The players change. The technology changes. But the structure, the pressure points, remain identical. And when you line up the past with the present, the resemblance becomes uncomfortable. Look at the 1930s, a world drowning in debt, governments trapped between collapse and denial, currency devaluations disguised as policy adjustments, confidence shattered, then patched together with emergency measures. Gold was controlled, silver was ignored, until it wasn't. Now look around. Debt is no longer a burden. It's the system itself. Interest can't rise without detonating governments. Printing isn't a choice, it's oxygen. Every crisis demands more liquidity, more intervention, more distortion. The language is softer now. The outcome is not. The 1970s told the same story with different costumes. War spending, energy shocks, monetary discipline abandoned, inflation dismissed, then feared. Gold broke free first. Silver lagged, ridiculed, dismissed as too volatile. Then it surged with a force that erased decades of complacency in months. Now compare that to today. War again, energy again, supply chains fractured, trust evaporating. And once again, gold is celebrated as the respectable hedge, while silver is treated like an afterthought. Too messy, too small, too inconvenient. The parallel is exact, but there's a difference this time. Silver is no longer just money, it's infrastructure. The modern world runs on electrons, and electrons run on silver. Solar panels bleed it. Electric vehicles consume it. Data centers, medical devices, AI hardware. Every symbol of the future depends on a metal the market insists on pricing like it's optional. In the past, silver had monetary demand and ornamental demand. Today it has monetary demand, industrial demand, and strategic demand, all colliding at once. And the supply? Weaker than ever. Decades of low prices gutted exploration. Most silver is mined as a byproduct, meaning production doesn't respond to price signals the way gold does. You can't just mine more silver when demand spikes. The system has no surge capacity. This is the part the parallels make more dangerous. In the 1930s and 1970s, above-ground silver inventories still existed in meaningful quantities. Today they're thin, fragile, already spoken for by industry, already leased, rehypothecated, promised multiple times over. Paper markets say silver is abundant. Reality says it's disappearing. And just like before, the ratio reflects the lie. It stretches wider not because silver is worthless, but because it's being sacrificed to maintain the illusion of control. Silver absorbs the distortion so the system can pretend stability still exists. Gold is allowed to rise. Silver is forced to wait. That waiting is the warning. In every historical parallel, the moment silver breaks free is the moment confidence breaks down. When industrial users compete with investors, when physical delivery matters more than paper settlement, when price stops being theoretical and starts being enforced by scarcity. We're closer to that moment than most realize, because unlike the past, today's world cannot function without silver. A repricing isn't just a financial event, It's a supply shock. And supply shocks don't resolve gently. They resolve through price violence. The parallel is clear. Debt saturation, monetary dilution, war, energy transition, suppressed silver, elevated ratio. Every ingredient that preceded silver's historic repricings is present again, only larger, more leveraged, more fragile. This doesn't end with balance. It ends with overshoot. Silver doesn't just catch up to gold in these moments, it overcorrects. It reclaims decades of suppression in a compressed window of time. That's how parallels resolve, not gradually, but suddenly. Those who study history see this coming. Those who live inside the system never do. Because parallels are invisible until they're undeniable. And by the time they're undeniable, positioning is already too late. Every distortion has beneficiaries. They don't advertise themselves. They don't leave signatures. But if you follow the imbalance long enough, the winners reveal who engineered it, or at least who exploited it. Silver did not become cheap by accident. It was made cheap. Because silver is inconvenient to those who run a debt-based system. Gold can be locked away, centralized, controlled. Silver cannot. It's too small, too distributed, too embedded in the real economy. When silver acts like money, it exposes inflation faster than any speech or statistic ever could. So it had to be neutralized. The method was elegant, invisible, legal, paper. Not paper money, but paper silver. Futures contracts, unallocated accounts, ETFs, derivatives stacked on top of derivatives. Claims on silver that outnumber physical ounces by orders of magnitude. A market where price is discovered not by possession, but by promise. This is the revelation most never confront. The silver market is not a market for silver. It's a market for confidence. Banks sell silver they don't have. They roll contracts instead of delivering metal. They settle shortages with cash and call it liquidity. And as long as participants accept paper instead of physical, the illusion holds. Who benefits? Bullion banks, primary dealers, institutions with direct access to central liquidity, entities that profit from volatility without ever touching the metal. Entities that can suppress price, harvest leverage, and reset positions when panic hits. Silver's volatility is not a flaw, it's a weapon, used against those who don't understand the game. When price spikes, margin requirements are raised, long positions are forced out, the rally dies. When price collapses, physical disappears quietly into strong hands. The pattern repeats. Retail gets shaken. Institutions accumulate. This isn't conspiracy, it's structure. Silver had to be rebranded. No longer money, just an industrial metal. Something cyclical, something expendable, something that belongs in factories, not vaults. Once that narrative stuck, suppression became easier. Who panics about the price of an input? But here's the paradox they didn't solve. An industrial metal that is also irreplaceable becomes strategic. And a strategic metal cannot be suppressed indefinitely without consequences. Because industry doesn't trade futures, it needs delivery. And delivery is where the system fractures. The same institutions that downplay silver's importance are the ones with the most exposure to its shortage. They rely on just-in-time inventories, globalized supply chains, and price stability that no longer reflects reality. They're betting the public never demands the metal. They're betting confidence never breaks. They're betting the ratio can stay distorted forever. This is the betrayal. Not that silver was forgotten, but that it was deliberately obscured. The public was taught to fear its volatility, mock its returns, and chase assets inflated by the same liquidity that silver threatens to expose. Meanwhile, the elite positioned quietly. Physical silver doesn't sit on balance sheets the way derivatives do. It doesn't need leverage. It doesn't need permission. And that's exactly why it's dangerous to a system built on abstraction. Because when physical demand overwhelms paper supply, price stops being negotiable. That moment doesn't arrive with announcements. It arrives with failure. Failed deliveries, force majeure clauses, cash settlements offered where metal was promised. industrial buyers panicking, governments suddenly classifying silver as critical. And when that happens, the narrative flips overnight. The same voices that dismissed silver will call it strategic. The same institutions that suppressed it will claim foresight. The same system that betrayed it will pretend it was inevitable. But the revelation remains. Silver was never mispriced because it was weak. It was mispriced because it was telling the truth too early. And those who control the system needed time. Time is running out. No cycle ends quietly. It ends when pressure overwhelms control, when the system exhausts its ability to delay the inevitable. And the closer you get to that point, the more desperate the distortions become. The gold-silver ratio cannot stay broken forever. It never has. Not because markets are fair, but because reality eventually asserts itself. Ratios are gravity. You can fight them with leverage, narratives, and paper promises for years, but when they reverse, they do it with force that erases the memory of suppression. This is where we are now. Silver doesn't need belief to rise. It doesn't need consensus. It doesn't need permission from analysts or institutions. It only needs one thing to happen: demand for physical metal exceeding the system's ability to fake supply. That moment is closer than it appears. When the ratio turns, it won't signal gently. It will collapse. And in every historical reset, silver doesn't move 20%. It doesn't move 50%. It reclaims decades of mispricing in a single violent phase. 200%, 300%, 500%, not as fantasy, but as arithmetic. If gold holds its value while silver merely returns to historical balance, the upside is already extreme. If gold rises, as it always does during systemic stress, silver's move becomes exponential. This is not leverage, this is convergence, and convergence doesn't negotiate. The system knows this. That's why silver is kept boring for as long as possible, because the most dangerous asset is the one nobody is watching, right before it matters. This is the final phase, where confidence looks stable because collapse hasn't announced itself yet, where paper still settles, where ETFs still promise exposure, where volatility is dismissed as noise until it isn't. When physical silver reprices, it will not wait for retail participation. It will not form neat bases. It will not offer clean pullbacks. It will move when access disappears, when the question is no longer at what price, but is it available at all? That's how inevitability expresses itself. Not through prediction, but through constraint. Those who understand this don't chase the move. They don't argue timelines. They don't debate narratives. They position before the system admits what it can no longer hide. Because by the time silver is celebrated, the opportunity phase is over. And this is the choice history always presents at the end of every monetary cycle. Paper comfort or physical truth? Abstraction or reality? Delay or acceptance? The ratio will reset. It always does. The only variable is who stands on which side of that reset when it happens. Because when silver finally breaks free, it won't ask who believed. It will only reveal who understood.